Welcome to the Pro Ticker Deep Dive.
It is definitely a heavy morning to be here. I mean, just looking at the screens today, good is definitely not the right word to use. Intense feels a lot more appropriate.
Intense is putting it very mildly. It is Monday, March 2nd, 2026. And I think for everyone listening to us right now, the world just feels like a fundamentally different place than it did when we all logged off last Friday.
Yeah, it really does.
You know that feeling when the air pressure drops right before a massive storm breaks? It feels like we've been living inside that pressure drop for 48 hours straight.
We absolutely have. You know, in finance, we really love to throw around the term paradigm shift. We use it for literally everything.
Like a new iPhone comes out or a new AI chatbot.
Exactly. Or a quarter-point interest rate hike from the Fed. We completely dilute the meaning of the word. But this weekend, this is the real deal. The tectonic plates of geopolitics and the global economy didn't just shift. They slammed into each other at full speed.
Yeah.
We aren't just looking at a standard breaking news story today. We are looking at a systemic shock. The kind of shock that forces a complete repricing of risk across every single asset class you can think of.
And we are, of course, talking about Operation Epic Fury, which I have to say the code name alone sounds like a summer blockbuster, but the reality of it is terrifyingly real.
It is.
We're talking about the coordinated airstrikes by the United States and Israel against Iran that commenced Saturday, February 28th. And then there was the headline, the one that I think stopped every trader, every politician, and just regular citizens in their tracks.
The confirmation.
Right, the confirmation of the death of Iran's supreme leader, Ayatollah Ali Khamenei.
That right there is the singularity event of this entire crisis. We have seen strikes before.
Sure.
We've seen assassinations of generals and nuclear scientists or proxy leaders over the years. But a decapitation strike on a head of state, the supreme leader of a major regional power, that is completely uncharted territory for the modern market.
It completely removed the central gravity of the Iranian regime.
Exactly. It removes the anchor. And the goal of this deep dive isn't to just give you a play-by-play of the military explosions. You can just turn on cable news for that.
Right. Our mission today is to figure out the plumbing. We need to look at what this kinetic event actually does to the hidden mechanics of the global economy. We need to move way past the ticker tape at the bottom of the screen.
Because the ticker tape is just reacting to the noise. We need to look at the signal.
So we are going to look at the absolute paralysis of the Strait of Hormuz, the clogged artery of the global energy world. But I don't just want to tell you that it's blocked. I want us to understand exactly how it is blocked when there isn't actually a physical wall built across the water.
Right. It's essentially a blockade by actuary table. We're going to get into the raw math of that because it is both fascinating and totally terrifying if you rely on global shipping.
Which we all do. And we're also going to talk about this massive rotation we're seeing in the markets this morning. I mean, I was looking at my portfolio over my morning coffee and the AI boom stocks, you know, the absolute darlings of the last 2 years.
The ones that could do no wrong.
Exactly. They are suddenly taking a massive backseat to old world assets like defense and energy. It literally feels like 1980 called and wants its portfolio back.
Is the revenge of the physical world. When reality gets kinetic software, suddenly takes a backseat to hardware, it's just a fundamental truth of markets during wartime.
And we absolutely have to talk about the crypto test. Because Bitcoin is behaving really strangely right now. It is not following the usual script for a global crisis.
No, it isn't. It is showing some very strong signs of decoupling, which is a massive signal for institutional investors. We'll dig into what the smart money is doing there.
And of course, the central bank nightmare. I saw one analyst this morning explicitly call this the mother of all bad timings for the global economy. So we have a ton to unpack. Let's just buckle up and start with the kinetic event itself.
Let's do it.
Just to ground us, because the fog of war is incredibly thick right now. What actually happened this weekend? Break down the military timeline for us.
So if we look closely at the timeline, this was not a skirmish. This wasn't one of those message-sending exercises like we saw back in 2024, where they basically hit empty warehouses in the desert.
Right, the performative strikes.
Exactly. Operation Epic Fury was designed from the ground up as a comprehensive, overwhelming strike. We are talking about U.S. and Israeli forces targeting the very top of the Iranian leadership structure.
Specifically, Khamenei.
Yes, specifically the supreme leader. But alongside that, there was a massive rapid degradation campaign against their ballistic missile capabilities and their naval infrastructure.
It sounds to me like they were trying to completely remove the pieces from the board before the game could even really start.
That's exactly what it was. It was a textbook decapitation strategy. You take out the head, you blind the eyes by hitting the radar installations, and you break the sword arm by destroying the missile silos.
And the rhetoric coming out of the White House was incredibly specific, too. President Trump really didn't mince words. I was reading the transcript of his address early Sunday morning, and it felt very different from standard diplomatic maneuvering.
No, he didn't hold back at all. He explicitly stated the goal was eliminating imminent threats. But what really stood out to geopolitical analysts, and this is a key point for the long-term instability we are pricing in today, was his direct appeal to the Iranian people.
Yeah, I noted that down.
He said, quote, "When we are finished, take over your government. It will be yours to take." That is explicitly encouraging a regime change from the inside.
Right, that's not just saying change your geopolitical behavior. That is saying we want you completely gone.
Precisely. And perhaps most concerning for the financial markets, he predicted this military operation could last 4 weeks.
4 weeks, that really stuck out to me too, because, I mean, in the real world, a month goes by fast. You blink and it's over. But in the financial markets, 4 weeks is an absolute eternity.
It is a lifetime. You have to remember, markets operate on milliseconds. Algorithms hate uncertainty far more than they hate bad news.
Right, if you tell the market oil's going to $150 a barrel tomorrow, the market can instantly price that in.
Exactly. The damage is done, but it's quantified. But if you say, we don't know if this war will last 4 days or 40 days, the market panics. That phrase, 4 weeks, implies a grind. It implies a sustained, brutal disruption to global supply chains.
And the response from Iran was immediate. I think a lot of people expected a delay. Usually there is a period of mourning or what the diplomats call strategic patience.
Right, the famous 4-hour turnaround that everyone was talking about this morning. In previous conflicts, like the assassination of Qasem Soleimani or the strikes in 2024, there was a distinct lag.
It took days or sometimes even weeks.
Exactly. Tehran would weigh its options. They would maybe activate a proxy in Syria, Lebanon first to test the waters. But this time, Tehran fired back within 4 hours.
Which suggests they were completely pre-positioned. They already had their finger on the trigger.
It absolutely suggests they knew this event was existential. And they didn't just target Israel in response. They expanded the theater of war immediately. We saw rapid strikes on U.S. bases in Bahrain, Kuwait, and Qatar.
And civilian infrastructure too, right? This wasn't just military on military rules of engagement.
Correct. And that is a crucial escalation point for the markets. We are seeing confirmed reports of drone attacks on energy sites and civilian areas across the Gulf Cooperation Council states, the GCC.
And the diplomatic context makes it even crazier. This happened right on the heels of what everyone was calling a constructive round of nuclear talks in Geneva.
The whiplash is incredibly real.
We literally went from diplomatic progress on a Thursday to a regional regime change war on a Saturday.
And that extreme whiplash is exactly what has left the markets so rattled today. The institutional risk models were all calibrated for a Cold War scenario. High-tension proxy fights, but ultimate stability.
But now we are in a hot war scenario.
Yes. The playing field is massive now, and it is absolutely not contained.
And that brings us directly to the most critical physical choke point in the entire world, the Strait of Hormuz. I feel like we talk about the Strait every few years whenever tensions flare up, but why is this time fundamentally different? Why is the fear level so much higher on the trading desks today?
So think of the Strait of Hormuz as the absolute jugular vein of the global economy. Physically, it's a strip of water that is only 21 miles wide at its narrowest point.
21 miles? That's nothing.
It gets tighter. The actual shipping lanes, the deep water channels that those massive supertankers need to safely navigate, are only 2 miles wide in each direction.
2 miles. You could see across that easily from the deck of a ship. It's incredibly intimate for such a vital global artery.
It is. And through that tiny 2-mile channel passes 20 million barrels of oil every single day. That is roughly 20% of total global consumption. 1 in every 5 barrels of oil used on the planet Earth goes through that tiny gap.
And it's not just oil, is it?
No, and this is the part the mainstream headlines often miss entirely. Over 100 billion cubic meters of LNG, liquefied natural gas, passes through there annually.
Wow.
If you choke that off, you aren't just making gas more expensive for a commuter in Ohio. You are potentially turning off the lights in Tokyo and freezing homes in Berlin.
And the current status right now.
The difference this time is that the flow has effectively stopped. Not because there's a physical wall of warships blocking every single inch of water, though the navies are definitely out there, but because of fear and insurance.
The invisible blockade. I really want to dig into this because I don't think people realize how the maritime insurance market effectively dictates global trade.
It really is a blockade by actuary table. Look,
Yeah.
every commercial ship on the ocean has insurance. You have your hull and machinery coverage and your protection and indemnity coverage.
Wretched basics.
Right. But when you sail into a designated war risk zone,
Hmm.
you need to buy a special rider for that specific voyage. Usually that's a tiny fraction of a percent of the ship's total hull value. Just a cost of doing business.
But not today.
Definitely not today. As of Sunday night, the major insurers in London, the Lloyd's Market syndicates, basically stepped back and said, we are done.
So they just completely pulled coverage.
They either canceled coverage entirely for the Persian Gulf region, or they quoted premiums that are so astronomically high, we're hearing quotes of 5% or even 10% of the whole value for a single trip, that it wipes out the profit of the entire voyage instantly.
Wait, so if I'm a captain for Maersk and my ship is worth, say, $100 million, I have to pay $5 million just to insure that one trip in and out.
Exactly. And the gross profit on moving that oil might only be $2 million.
Hmm.
So the math simply does not work. Even if the captain is feeling brave and wants to sail, the corporate CFO in Geneva or Copenhagen says, absolutely stop the ship.
So the ships are just sitting out there.
Major shippers like Maersk have officially paused all transits. We have satellite reports of hundreds of tankers just dropping anchor and sitting in safe waters in the Indian Ocean, just refusing to enter the Gulf.
So the artery isn't physically severed, but it is completely clogged by paper, by insurance contracts.
Yes. And within that massive logistical clog, there is a very specific crisis brewing that I think is vastly underreported this morning, and that is Qatar. We saw specific drone attacks on their facilities.
This is critical. Let's do a specific deep dive on the Qatar situation right now, because Qatar is what? A top 3 global LNG exporter.
They are. And over the weekend, we saw direct drone attacks on their energy facilities at Ras Laffan and Mesaieed. As a direct result of those strikes, Qatar Energy officially declared force majeure.
Now, for those listening who aren't corporate contract lawyers, force majeure is basically the act of God clause, right? It essentially means we cannot fulfill our legal contracts because the world has gone crazy.
That's exactly it. It translates to superior force. They are legally telling their top customers, countries like Germany, Japan, and China, we cannot load the ships because it is physically unsafe to operate the port.
So they just halted production.
They halted LNG production. This puts 20% of the entire global LNG trade at risk overnight. To use a biological analogy again, if Hormuz is the jugular vein, Qatar is the lungs for Europe's energy system, and Europe is hyper-vulnerable right now.
I was looking at the European gas storage numbers earlier. They really aren't great going into this.
They are extremely worrying. Europe is entering this specific crisis with natural gas storage levels at roughly 46 billion cubic meters.
Which sounds like a lot until you compare it to history.
Exactly. Compare that to previous years where, thanks to mild winters, they were sitting pretty at 60 or even 77 billion cubic meters. They have significantly less buffer this time.
And the market knows it.
The market absolutely knows it. We saw European benchmark gas prices spike about 40% this morning at the open. If this insurance blockade or the Qatar production halt lasts a full month, we could see prices go completely vertical. We are talking potentially back up to 200 or 400 euros per megawatt hour.
That brings back absolute nightmares of 2022. But there's a fascinating geological twist here regarding Qatar and Iran that I found incredible when reviewing the geology of the region. They are sort of Siamese twins.
It is a totally fascinating geological reality that heavily drives the geopolitics of the Gulf. The gas field in question is one giant underground reservoir. It is literally the largest natural gas field in the world. Qatar calls their side of the border the North Dome. Iran calls their side South Pars.
But it's the exact same milkshake.
It is the same milkshake.
Yeah.
They are both sipping from the exact same cup, just from different sides of the table.
So if one country drinks faster, it physically affects the other country's supply.
Exactly. It is just basic physics. Extraction operations on one side directly affect the underground pressure on the other side. This creates a massive long-term dilemma for Qatar.
Because politically they are U.S. allies, right? They host a massive U.S. military base.
Al-Udeid Air Base, yes.
Yeah.
So politically they lean west, but geologically they are permanently married to Iran.
And if the U.S. actually succeeds here, like if there really is regime change And sanctions are eventually lifted on a new Iran.
That is actually Qatar's long-term corporate nightmare. Right now, Iran is heavily sanctioned. They do not have the modern Western technology or capital to extract gas from South Pars efficiently.
So Qatar gets to dominate the field.
Right. But if Iran is suddenly freed from sanctions and gets access to Western, say if companies like Shell or Exxon go look into a newly democratic Iran, they instantly become a massive, fierce competitor for that exact same reservoir of gas.
Oh, wow. So they could ramp up production on South Cars and compete directly with Qatar for global market share.
Exactly. So Qatar is this bizarre position where they desperately need U.S. protection from missiles today. But a total U.S. victory actually hurts their core business model 10 years down the line.
That is four-dimensional chess right there. They are dodging physical missiles today while actively worrying about their market share in the 2030s.
That's global energy politics for you. It's never just one issue.
Well, speaking of market share and big money moving around, let's look at the Monday morning scorecard. The markets opened a few hours ago, and it was just a sea of red.
Deep, deep red in Asia. The Nikkei in Japan dropped about 1.5%. The Hang Seng in Hong Kong was down 2.5%. U.S. futures took an immediate hit, down about 1% across the board.
And obviously, oil did exactly what everyone would expect.
Brent crude spiked 13% initially on the open.
But it settled back down a bit, didn't it? It's hovering around $82 right now. Why didn't it shoot straight to $150 immediately?
There are a few key reasons for that moderation. One, global commercial inventories are actually decent right now. We aren't running on fumes globally just yet.
Because there's a cushion?
A small one, yes. And two, the market is basically playing a massive game of chicken. Traders are waiting to see if the Strait actually stays closed for weeks. If it does, $82 is going to look like an absolute bargain by Friday.
Right now, the geopolitical risk premium is just fully back in the driver's seat.
It is. However, the real story today isn't just that everything is down. It's about where the actual money is moving under the surface. We are witnessing a great rotation.
The winners and losers. And looking at the tape, the losers seem to clearly be the darlings of the last 2 years, tech and AI.
The AI trade is taking a massive hit today. Look at NVIDIA, they're down 1.6%. Microsoft is hurting. And the macroeconomic logic here is fairly straightforward.
War is inflationary.
Exactly. War is highly inflationary. If oil and natural gas prices spike, it costs more to move goods, it costs more to manufacture plastics, it costs more to power data centers. Everything goes up.
And if inflation comes roaring back, the Federal Reserve has to keep interest rates high to fight it.
And high interest rates are absolute kryptonite for high-growth tech stocks. If I'm buying a share of NVIDIA today, I am essentially buying their projected earnings for the year 2030.
Right, you're paying for future growth.
But if risk-free interest rates are sitting at 5 or 6% instead of 2 or 3%, those future 2030 dollars are worth a lot less today. The broad narrative is shifting rapidly from an AI capex boom, where every corporation on Earth is buying tech chips, to a conflict capex reality.
Conflict capex. I actually really like that term. I don't like what it implies, but it makes perfect analytical sense. It means sovereign governments and huge companies are urgently shifting their budgets from nice-to-have software upgrades to must-have physical hardware.
Precisely. And that brings us to the clear winners today. The defense supercycle. European defense stocks are absolutely flying off the shelves.
Give us some numbers.
BAE Systems is up between 5 and 8%, depending on the exchange. Rheinmetall in Germany is up 4%. And there is a very specific technical supply chain reason for BAE Systems popping so hard today. It connects directly back to the actual missiles we are seeing lighting up the sky in the Middle East right now.
The Tay sister, right? I saw that in the briefs.
Yes, the THA, Terminal High Altitude Area Defense. It is the premier shield being used by the U.S. and Israel right now to intercept these incoming Iranian ballistic missiles.
So it's getting a heavy workout.
A massive workout. The core issue is they are burning through these interceptors at an incredibly alarming rate. Military analysts estimate the entire U.S. stockpile is currently sitting at fewer than 650 THAAD units globally.
Wait, fewer than 650. That seems incredibly low for a global superpower facing multiple theaters of conflict.
It is shockingly low given the current threat environment. And here's where the market comes in. BAE Systems manufactures the infrared seeker for that specific missile guidance system.
It's the eye of the missile.
It's the eye, exactly. And financial analysts at JP Morgan estimate that just the seeker and its related tech generates about $1 million in revenue per unit for BAE.
$1 million just for the sensor on the front of the missile.
Just for the sensor. So as those stockpiles deplete, and they're depleting very rapidly this weekend, Those assembly factories have to transition to running 24/7 just to replenish the baseline inventory.
That is highly tangible, immediate revenue. This isn't a speculative growth story.
No, this is actual purchase orders being signed by the Pentagon today.
Yeah.
So the market is aggressively pricing in a massive multi-year restocking cycle. It's a fundamental shift from valuing corporate efficiency to valuing national resilience and security.
And on the complete flip side of that, travel and leisure are just getting hammered. I saw the cruise lines took a massive nosedive at the open.
Carnival, Norwegian, they're down about 10%. And it makes total sense that who in their right mind wants to book a luxury cruise in the Persian Gulf or even the Eastern Mediterranean right now?
Nobody.
Plus, the global airlines are dealing with massive new airspace closures. They have to fly much longer, less efficient routes to avoid the active war zones.
Which burns a lot more jet fuel.
Exactly. And the jet fuel itself just got significantly more expensive over the weekend. It is a brutal double whammy for their operating margins.
Now, usually when the geopolitical world looks like it's ending, people buy gold.
Yeah.
That is the oldest trade in the book. And that is happening today. Gold is at record highs over $5,400 an ounce.
Central banks have been aggressively buying gold for 4 straight years to diversify away from the U.S. dollar out of fear of sanctions.
Right. But the asset class I really want to talk about right now is the one that usually crashes the hardest when things get scary.
Crypto.
The crypto anomaly. This is a genuinely fascinating development.
Usually Bitcoin is treated by the algorithms just like a high beta tech stock. A war starts, risk-off sentiment takes over the market, and Bitcoin crashes hard.
Yeah.
And to be fair, it did drop initially, right? It went below 64,000.
It did. But it didn't collapse. And that resilience is the real story here.
In the initial total panic on Saturday, sure, it sold off. That is just the automated knee-jerk reaction of the market. But look at what happened in the days leading up to this and during the weekend itself. We actually saw 3 consecutive days of net positive inflows into the spot Bitcoin ETFs.
Wait, while the literal drums of war were beating in the Middle East.
Exactly. While the bombers were in the air, money was flowing into Bitcoin ETFs. This heavily suggests a major shift in who is actually holding the asset. It is not just retail panic sellers driving the price anymore.
This is smart money.
This is institutional capital buying the dip during a geopolitical crisis.
Why, though? What is the institutional thesis there?
They are increasingly viewing it potentially as a sovereign hedge against the traditional banking system or the threat of global sanctions, rather than treating it just as a speculative tech play.
Because the historical precedent is very different.
Very different. Look at previous conflicts like the start of the Ukraine war in 2022. Bitcoin fell in near-perfect lockstep with the NASDAQ index. If tech stocks went down, Bitcoin went down. It was a pure risk asset.
But now we are seeing actual signs of decoupling.
Decoupling, yes. It is behaving a little bit more like digital gold, a non-sovereign hedge, though it obviously remains incredibly volatile on a day-to-day basis.
But if the traditional banking system looks shaky because of sweeping new sanctions or frozen sovereign assets, Bitcoin, which sits entirely outside that traditional SWIFT system, suddenly starts to look like highly viable insurance.
It's passing a massive real-time stress test right in front of us. If it manages to hold these price levels through the rest of the week, that digital gold narrative is going to be permanently cemented in the minds of asset managers.
That is a huge psychological shift for the broader market.
Okay, let's zoom out to the macro picture for a minute. You mentioned earlier in the show that one analyst called this the mother of all bad timings. Why is that? I mean, before Friday, the global economy seemed to be doing relatively okay.
It was doing okay on the surface, but underneath it was deeply fragile. The global economy was already heavily juggling 2 massive macro headwinds.
Like the post-COVID hangover. First, we still have the post-COVID supply chain fragmentation. We've moved away from true globalization. Things just aren't moving across borders as seamlessly or efficiently as they used to.
And the second headwind.
Second, we have this aggressive new tariff offensive. The global trade wars that have been steadily ramping up between the major economic blocs.
So basic global trade was already getting significantly more expensive and much slower before a single shot was fired.
Right. And now you drop a massive physical energy supply shock right on top of that fragile system. This creates an absolute nightmare scenario for the central banks globally, but specifically for the Federal Reserve.
Walk us through the Fed's dilemma here, because I feel like Jay Powell must be literally pulling his hair out this morning.
He definitely is.
Yeah.
Okay, so imagine you are the chairman of the Fed right now. You have 2 highly conflicting scenarios playing out simultaneously. Scenario A is that the sheer fear of war causes businesses to pull back.
They stop hiring, they stop investing.
Exactly. Corporate investment drops, consumers stop spending, and the broader economy slows down toward a recession. In that world, the Fed textbook says you should cut interest rates aggressively to stimulate growth and make borrowing cheap.
That's the standard recession playbook we all know. Make money cheap so people go out and spend it.
Correct. But then you have scenario B, oil and natural gas prices skyrocket globally because of the regional conflict.
Which acts like a tax on everything.
Yes, that drives up the baseline price of global shipping of agricultural food production, of manufacturing plastics, literally everything. Broad inflation comes roaring back into the system. In that scenario, you must raise rates or at least hold them very high to crush demand and kill the inflation.
And we are currently facing scenario B.
The trap is that we are effectively facing both scenarios at the exact same time. The real economy might slow down rapidly because of the fear of war, while baseline consumer prices go up because of the spike in energy costs.
Which leads us to the one word economists fear more than anything else: stagflation.
Stagflation. Stagnant economic growth combined with high, sticky inflation. It is historically the absolute hardest macro trap to escape from.
Because your policy tools cancel each other out.
Exactly. If you cut rates to help revive the stagnant growth, you cause inflation to absolutely explode. But if you raise rates to kill the inflation, you crush the underlying growth even harder and trigger a deep recession. You are completely stuck. A second major inflation wave right now makes rate cuts incredibly hard to justify to the public, which keeps immense pressure on the broader economy.
And it's not just the U.S. dealing with this. I imagine the Asian markets are sweating profusely right now, given their energy mix.
Asia is incredibly vulnerable to this specific geography. Look at countries like Japan and the Philippines. They import roughly 90% of their crude oil directly from the Persian Gulf.
90%.
Yes, they essentially do not have domestic hydrocarbon reserves to fall back on. If the Strait of Hormuz stays blocked for an extended period, their manufacturing industries literally run out of physical power. The lights go off in the factories.
But what about China? I noticed looking at the board, their markets were strangely calm today. I think the Shanghai index was down only, 0.2% compared to Japan's 1.5% drop? It seems really odd given that they buy so much of the sanctioned Iranian oil.
It does seem odd at first glance, but the global market is making two very specific bets regarding China right now. One, the market assumes the Chinese state apparatus will intervene massively to artificially prop up their domestic equities market. They simply won't let it crash on a geopolitical headline.
That makes sense. State control. And the second bet.
Two, Cobra. The market recognizes that China has spent the last entire decade quietly building massive land-based energy supply alternatives.
You're talking about the pipeline networks.
The pipelines.
Yeah.
The massive overland pipelines from Russia and the Central Asian republics.
Yeah.
They have systematically insulated themselves slightly better than island nations like Japan, which rely entirely on vulnerable maritime sea lanes. The market is actively rewarding that physical resilience today.
And there's that theme again. Resilience over pure economic efficiency.
Let's pivot slightly to the immediate political fallout actually inside the region. We mentioned the GCC earlier, the Gulf Cooperation Council. They held an emergency session over the weekend. What exactly came out of that room?
It was their 50th extraordinary session, and the public statement they released was a true masterclass in high-wire diplomatic tightrope walking.
How so?
Well, they issued a very strong formal condemnation of Iran. They officially called the retaliatory strikes heinous attacks. They expressed absolute public solidarity with Qatar, Saudi Arabia, and Kuwait.
Which they have to say. They have to project a united regional front to the world.
They absolutely do. But the deep nuance is in their actual strategic position. They are caught in the literal crossfire of a superpower conflict.
Right.
They host the massive U.S. military bases that are actively drawing the Iranian missile fire, but they physically live next door to Iran. They can't exactly pick up their countries and move them to a different continent.
So they are trapped. They are trapped. So they desperately want U.S. protection and the security umbrella, but simultaneously they desperately want immediate regional de-escalation because it is their own domestic cities and energy ports that are currently burning.
They are essentially the ones living in glass houses in the middle of a massive rock fight.
It is the perfect analogy. And if you look inside Iran right now, Khamenei is confirmed dead. That is a huge, monumental shift. It creates an absolute immediate succession crisis at the very top of the theocratic state.
And this is exactly where President Trump's aggressive rhetoric becomes a massive historical wild card. When he explicitly tells the Iranian people on global television to take over your government, he's making a huge bet on a popular civilian uprising.
He is.
Is that actually a likely outcome? I mean, we have seen massive widespread protests in Iran several times over the last few years.
We certainly have. The underlying civilian frustration is absolutely real, but modern political history strongly warns us that sudden power vacuums rarely lead to an instant clean transition to a Western-style democracy.
They usually lead to chaos.
They often lead to a brutal civil war or a rapid consolidation of hard power by the guys who already hold all the guns.
In this specific case, that would be the IRGC, the Islamic Revolutionary Guard Corps.
Right. If the top clerical establishment is suddenly decapitated, the hardline military wing almost always steps in to ruthlessly restore order and secure the state. We could very easily see a pure military dictatorship rise from the ashes of this strike, rather than a liberal democracy.
And the market hates that kind of opacity.
It does. The absolute profound uncertainty of who is actually in charge of the advanced military assets and the nuclear program in Tehran this morning is heavily fueling that massive risk premium we are seeing across the equity markets.
So where exactly do we go from here? Because we have some leading geopolitical experts projecting a few different paths forward. Let's walk through these scenarios systematically from the best case outcome to the worst case so our listeners know exactly what signals they should be watching for this week.
Sure, let's break it down. Let's start with scenario one, which is the tactical ceasefire. This is the highly optimistic view that the market is praying for. In this scenario, the extreme intensity of the conflict only lasts maybe 4 to 7 days.
A very short window.
Right. The U.S. and Israel rapidly exhaust their primary target lists. They successfully hit the nuclear development sites, they hit the key military command centers, and then the operational tempo drops significantly simply because there isn't much high-value infrastructure left to hit.
And how does Iran react in that best case scenario?
In scenario one, Iran's continuing retaliation stays largely performative. They launch enough localized strikes to save political face domestically, but they intentionally avoid crossing the threshold that would force a massive regional ground war.
So the tension diffuses.
Exactly. In this optimistic world, the Strait of Hormuz opens back up to commercial shipping relatively quickly. The insurance premiums drop, oil stabilizes somewhere around $85 to $95 a barrel. The global markets breathe a massive collective sigh of relief, and we get a sharp relief rally in equities.
Okay, well, that is the optimistic one. We will all keep our fingers crossed for that. But we have to be realistic. What is scenario two?
Scenario two is the forever war. This directly aligns with Trump's public 4 weeks comment, or potentially drags on much longer. In this scenario, the remaining Iranian leadership realizes it absolutely cannot win a direct conventional head-to-head war with the U.S. military, so it vastly expands its asymmetric warfare operations.
Meaning they activate all their proxies across the entire Middle East?
Yes, they aggressively reactivate the Houthi militants in the Red Sea to target shipping again. They use small, fast attack boats and swarms of cheap drones to constantly harass any commercial ships trying to transit Hormuz.
So that invisible insurance chokehold we talked about just tightens and stays tight indefinitely?
Exactly. Qatar's massive LNG exports stay offline for weeks or months because those Lloyd's of London insurance rates never come back down to earth.
And the economic impact of that?
In this sustained conflict world, global crude oil easily breaks $100 a barrel and stays there. European natural gas breaks 100 euros per megawatt hour. We are pushed into a severe global trade recession. The fragile supply chains break down all over again.
This is the realization of the stagflation nightmare we discussed.
It is the absolute worst-case scenario for the central banks.
And what about the wild card? You mentioned a third scenario.
Scenario 3 is full regime change or state collapse. This is the highly chaotic, highly unpredictable wild card. The central Iranian regime completely crumbles internally under the immense pressure of the coalition strikes and massive internal civilian dissent.
Which on paper sounds like a massive geopolitical victory for U.S. stated objectives. But what does a state collapse actually do to the global financial market?
It is deeply ironic. In the very short term, it causes absolute chaos. You have factional civil war, widespread regional uncertainty, and massive spikes in volatility.
Because nobody knows who controls the country.
Right. But in the long term, a post-regime Iran that is eventually stabilized and entirely free of Western economic sanctions fundamentally puts significantly more oil onto the global market.
Because they can finally export freely.
Exactly.
Yeah.
If Iranian heavy crude legally comes fully back online with Western investment, we could paradoxically see the price of global oil actually crash down to maybe $60 a barrel by the fourth quarter of 2026.
Wow. So the ultimate long-term macro result of a massive, highly disruptive Middle Eastern war could eventually be incredibly cheap global energy.
Eventually, yes.
Yeah.
But the timeline and the path from here to there is incredibly violent and economically dangerous. You have to endure walking straight through the fire just to eventually get to the discount on the other side.
It really feels like the entire global economy is walking a very thin tightrope right now without a safety net. So let's try to wrap this up for the audience. What is the absolute big takeaway for the listener today? If they're walking into a strategy meeting or a portfolio review this afternoon, what is the core thesis they need to understand?
The core thesis is that we are decisively in a new macro regime. The previous 30-year era of prioritizing pure economic efficiency, just-in-time inventory delivery, the absolute cheapest possible energy sources, hyper-globalized supply chains, that era is officially dead.
It's gone.
It is gone.
Yeah.
We are now firmly in the era of systemic resilience. Global investors are aggressively valuing security and hard assets. That is exactly why the defense sector energy companies and physical gold are winning big today.
And conversely, growth stocks, tech, and the AI narratives are losing because their massive valuations entirely depend on that old world of easy money, cheap power, and perfect geopolitical stability.
Exactly. The physical global energy map is being violently redrawn in real time right in front of us.
Yeah.
You simply cannot afford to ignore the hard physical reality of where your energy actually comes from anymore.
I want to leave the listeners with a very specific thought that struck me this morning while I was reading through the various analyst notes regarding the AI boom. We have spent the last 2 solid years as a market completely obsessed with digital intelligence, right?
Absolutely.
We talk endlessly about large language models, the expansion of the cloud, virtual realities, but every single piece of that digital miracle relies entirely on massive, uninterrupted amounts of baseline electricity.
It absolutely does. AI data centers are some of the biggest energy hogs the industrial world has ever seen.
Right. So if the Strait of Hormuz remains effectively closed by this insurance blockade and the baseline global cost of power spikes dramatically over the next quarter, have we all just suddenly realized that the single biggest existential threat to our pristine digital future is actually old-fashioned physical geography?
That is profound.
Is this massive AI supercycle that everyone is betting their retirements on about to be completely strangled in its crib by an old-world kinetic energy crisis?
That really is the defining question of the year for the markets. The cloud, as they say, is just a physical computer sitting somewhere else. And that physical computer needs constant, reliable power. If the power grid gets too expensive or the supply chains break, the cloud simply evaporates.
A deeply sobering thought to end our coverage on today. The shiny digital world ultimately lives completely at the mercy of the messy physical world. We will obviously be tracking this fast-moving situation very closely on the desks as it develops throughout the week. Stay safe out there and stay informed.
And definitely keep watching the Strait.
Thanks for listening to the Pro Ticker Deep Dive. We will see you next time.